Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. In the US market, it is not uncommon to see a situation that goes roughly along the following lines. A company grows year on year and meets or even beats revenue and earnings guidance, but then it goes and drops 5% or more in after-hours trading based on the forward guidance they give to the market. Now, there are a lot of concepts that we can unpack here that are very relevant from an investment perspective. And I'm not just talking about the existence of after-hours trading in the US, something we definitely don't have here. Let's start with the most basic concept of all, growth. Why does growth matter? If you're investing in equities, it's because you're expecting to achieve above inflation returns thanks to underlying growth in a business. Now, if your alternative is to go and buy fixed income instruments that will give you above inflation returns just from their yield, like for example South African bonds, then equities need to achieve returns that are way above inflation and well above those fixed income yields as well. Now, there's only one way that this is going to happen over time, especially over a long enough period of time. Earnings growth. Sure, there will be changes to the valuation multiple over time, and these changes will either boost or reduce the return to shareholders depending which way the multiple moves. But unless you're looking at the tech sector in the US or a handful of crazy share prices like Walmart and Costco, the reality is that eventually returns are going to tend towards annual earnings growth. If the multiple stays constant, then the number to which the multiple is applied will be what drives the share price, and that is the earnings number. Even in the frothiest of sectors, multiples cannot increase forever. Hence, when it comes to equities, the market is looking for growth. Even value investors are actually looking for growth, just as a far less important part of their decision. And growth investors, the group of people who have really been driving markets in recent years, well, the name tells you everything there, right? But what exactly needs to grow? Now, this is where it gets interesting. My observation of the situation is that the focus on revenue or earnings is going to vary based on sector and location. For example, in US tech, top-line growth is where it's at. The founders in that space and the investors supporting them are eternal optimists. They believe that they can change the world, and in many cases, that is precisely what they are doing. Now, you don't change the world by finding 100 basis points of efficiencies in a business. You change the world by getting more users and introducing new products. To justify eye-wateringly high valuation multiples, it is all about top-line growth rather than profits. Palantir and of course the entire AI movement would be the poster child for this right now. If you move outside of tech though, then you will quickly find yourself in a space where there's a better mix of growth and value investors. Retail, banking, industrials, these are sectors where profits actually matter, and although a miss to revenue guidance is not going to be celebrated, making up for it by hitting earnings guidance will help. In tech, even if earnings guidance is met or exceeded, missing on the top line, that's going to get punished. In South Africa, we've been so browbeaten by years of anemic growth that we are actually accustomed to seeing high single-digit revenue growth and getting excited about it because that means it's a couple of 100 basis points ahead of inflation. If costs are well controlled, this can lead to double-digit earnings growth, and in this town, that often means a PE multiple in the high teens or more. Our market is extremely focused on headline earnings per share, or HEPS, and thus price earnings or PE multiples. We are not nearly as interested in metrics like adjusted EBITDA and normalized earnings. Lasaka Technologies is a lovely way to see this in practice because they report their earnings in a US tech style, even though they are also listed here on the JSE, and hence it really sticks out on the local market if you're only used to reading JSE earnings announcements. But if you're used to reading US tech announcements, it's going to be familiar to you, and that tells you a lot about the relative focus areas of investors in each market. We now need to talk about the existence of guidance, because on the topic of South Africa, it's well worth highlighting that the concept of revenue and earnings guidance is not nearly as entrenched here as it is in the US. A US management team cannot get away with just not giving guidance unless they are deep in an uncertain turnaround. It's just not okay, and it will not be accepted by investors. In South Africa, other than in the mining industry with a culture of production and cost guidance, or perhaps in property funds with guidance on distributable earnings, you will really struggle to find much in the way of guidance. Of course, this makes life easier for management teams, so don't expect the situation to change very easily. Again, the difference is stark when you look at locally listed companies that also have a US following, Lusaka once more, and also Karoo with all the O's, are great examples where there is much focus on providing and then meeting guidance. For local groups appealing only to local investors, some wishy-washy commentary about a difficult outlook is about as much as we usually get. Of course, this is great for sell-side equity analysts as it makes their forecasts even more valuable to institutional investors. Just because there isn't management guidance doesn't mean there isn't an expectation in the market regarding performance. Now, going back across to the US where you do get guidance, the market in the US is not so simple that everyone just takes that management guidance and then treats it as a guarantee. There is still a market for sell-side analysts. These analysts then have their views pooled into a market expectation, also known as consensus earnings. Consensus earnings will only be the same as management guidance if the analysts all believe in precisely what management is saying. Now, if analysts do that as a matter of course, you have to kind of question their reason for existence. So you can expect to see deviance almost because there's an incentive for it, much like how there's an incentive for compliance people to find something wrong. This is why a company can meet guidance yet miss expectations, or beat expectations despite missing guidance. But we still haven't gotten to the most important part here, forward guidance. Big valuations mean bigger expectations, and in a US market filled with growth stocks and multiples that are way above historical averages, the future matters more than the past. Thus, guidance for the next period will drive the price more than recent performance. This is because a slowdown in growth will inevitably be extrapolated in forecasts. This has a huge impact on future expected cash flows, the underpin of any equity valuation, yes, even in growth land. Amazon is a lovely example hot off the press. Despite management trying to point out to the market that forex movements are a major driver of weak guidance that's now been given, the headlines still latched on to Amazon giving this really disappointing guidance. They expect revenue growth of just 5% to 9% in the first quarter, and that's the kind of growth rate you expect to see from mature JSE-listed companies, not one of the most exciting tech companies in the world. Amazon's share price is up 40% in the past 12 months. It's on a PE multiple of over 50. And here it is with revenue growth in mid-single digits. In after-hours trading, things settled down to a drop of 2.8% in the Amazon share price after the release of earnings. That's in the red, of course, but it still seems like a tiny price to pay for weak guidance after such a strong rally in the past year. Clearly, it takes a lot for tech investors to sell their beloved Magnificent Seven. But if anything is going to do it, if anything is going to cause this really big sell-off, it will be a few quarters in a row of poor guidance from the big dogs like Amazon. And this is why you should always, and I mean always, read the guidance section of the earnings transcript, not just the report on the quarter that just ended. If everyone else is reading that part, you should be reading it too. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.